This here is Michael Burry, or kind of anyway, it's kind of him in the movie called The Big Short, which was the story of how Michael Burry predicted the global financial crisis of 2007. But here is Michael Burry in real life, just in case you were interested. Now, the reason why Burry is so famous within the investing community, and the reason why he's so widely talked about over here on YouTube, is simply due to the fact that his predictions have allowed him to personally profit over $100 million from shorting the housing market back in 2007. And of course, anyone looking here on YouTube is always looking for that next hot prediction on what's going on in the stock market. And well, fortunately for us, Michael Burry is still around to provide them. And he does so through a series of tweets, which he then later goes on to delete. On Twitter, he goes by the name Michael J. Burry, or Cassandra, so his Twitter handle says. And his latest prediction is that there's going to be quite a catastrophic outcome for both the stock market and the economy in 2022. So today I'm going to try and decode what can be on occasion quite cryptic tweets, and whether Burry's predictions could certainly come true, and if they do, what that means for us as investors. So let's go back and discuss some of the most popular tweets in chronological order, because the tweets that I want to discuss, you guys, have certainly been catching the eyes of investors. Not just because they can be quite provoking in nature, but also because some of them have already started to come true. So let's take a look at them. This time last year, on June the 15th, 2021, Burry tweeted, "People always ask me what's going on in the markets. It is simple. The greatest speculative bubble of all time in all things, by 2 orders of magnitude. Hashtag Flying Pigs 360. Now, the theory around a stock market bubble has been largely spoken about for some time, but the quote greatest speculative bubble of all time can certainly raise some eyebrows. Now, to provide context to this, speculation is the purchase of an asset with the hope that it will become more valuable in the near future. Many speculators pay little attention to the fundamental value of a security and instead focus purely on price movements. So Burry is kind of inferring that the investing community are no longer paying any attention whatsoever to the fundamental intrinsic value of an asset which you're investing into, and instead are just blindly following price action instead. And that doesn't just go for, I guess, what you could deem as more speculative areas like cryptocurrencies and altcoins, but it also spans across the IPO market as well as your already profitable blue chip stocks of today. Because even some of the biggest and the best and the most innovative companies on the planet today still have been somewhat overvalued over the past couple of years. And now, whilst this was a viewpoint from Michael Burry, it certainly wasn't any kind of secret. It was a largely spoken about situation over at least the past couple of years or so, and it was kind of a situation that was evolving on a month by month basis. Now, the reason why I say this has not been any secret is because we can actually look at the evidence and the data to show this taking place. Because one way that we can actually look to value a productive asset like a stock is to actually look at one of the most common valuation metrics, which is called the price to earnings ratio. Now, the price to earnings ratio, or PE ratio for short, is simply a way to measure how much you're prepared to pay for every dollar in earnings a company generates. And the higher the price to earnings ratio, the higher that investors are prepared to pay for a share within that company. And for comparison's sake, we can also look at the historical price to earnings ratio, inflationary adjusted, compared to all the previous years throughout the course of history to actually see whether this has actually been the greatest speculative bubble throughout the course of history. And as you guys can see, aside from the dot-com bubble, the peak of this current market certainly suggests that we're actually trading in very speculative territory, because investors on average were prepared to pay just for the broader stock market index 37 times earnings. And even now, as I record this video, the comparison still very much remains relevant despite the fact that the stock market is actually sold off, because as of right now we're actually trading at the very same price multiple as at Black Tuesday at the peak of 1929, and we all know what happened after that. But for those of you guys who don't, and for those of you guys who haven't watched my previous video, the Dow Jones Industrial Average went on to crash 90% thereafter. Now, following that tweet, Burry also followed up with another, and he said all hype and speculation is doing is drawing in retail investors before the mother of all crashes. And look, Michael Burry certainly seems to be right, with the Dow Jones Industrial Average being down 15% year to date, and the S&P 500 being down 20.25%. But with the mother of all crashes being the prediction, just how much can we actually quantify how far the stock market could fall down in value? Now, the way in which I look at this is that markets certainly run within cycles. On occasion, we have bull market cycles, and then on other occasions, we have bear market cycles. Now, when these bear markets kick in, we do invariably see a reversion back to the mean market price to earnings ratio, which is this line just here at about 15 to 16 times earnings. So we do, for sure, as of right now, still certainly have some margin for the stock market to continue to fall down in value. However, putting an exact number on that would simply just be me guessing. However, for context, the average bear market is about 33%. So I think we can certainly say with probably quite a high degree of confidence that we could at least expect an additional 10 to perhaps 15% worth of downside to come. But then nearly 12 months on, thankfully for us guys, Burry gave us a little bit more of an insight as to how much he expects the stock market to crash. He gave his first indication back on May 24th by saying, as I said about 2008, it is like watching a plane crash. It hurts, it's not fun, and I'm certainly not smiling. And neither am I, because plane crashes typically don't end all too well. Apart from that time when the plane landed on the Hudson River, but that's another film for another day. Nonetheless, it does certainly give us somewhat of an indication that Burry, perhaps in the back of his mind, is certainly forecasting that the kind of downside that we saw in 2008, where the stock market crashed about 56%, could certainly be relevant and applicable to the stock market crash of today. However, just a few days ago, Burry then went on to give a few more specifics. He goes on to say, adjusted for inflation, 2022 first half, the S&P 500 was down 25 to 26%. The Nasdaq down 34 to 35%, and Bitcoin down 64 to 65%. And that was a multiple compression. Next up, an earnings compression. We may be halfway there. Now, this is certainly an interesting point because Burry certainly believes, based on that tweet anyway, that as of right now, all we've actually seen is a multiple compression, i.e., a price compression within the market. Remember when we spoke about the price to earnings ratio? Well, it's the price bit of that formula that Burry believes is the only thing that's being accounted for. And of course, as we've seen, prices within individual stocks as well as the broader stock market have certainly come down. And that is based on one of the biggest and core macroeconomic indicators which everybody is being affected by right now, which also looked like it was on his mind whilst he was writing that tweet, which is inflation, which, as we all know, is currently at multi-decade highs. So the initial shock to the stock market based on these broader macroeconomic indicators certainly looks to have been priced in. However, what has yet to happen is to actually understand the true inflationary impact on a company's earnings. And the way in which that happens is quite simple. As the cost of living continues to rise, people then spend less money, and as people are spending less money, then companies are earning less in revenue, and therefore that translates into lower earnings on the whole. And remember what I said around one of the key valuation metrics being the price to earnings ratio. Now, if all we've got is a multiple compression, i.e. a price compression where the price of a stock is falling down in value, but we're not yet seeing earnings affected, then what actually we might be seeing is price to earnings ratios that actually look somewhat more favourable than they actually are in reality. It's why stocks like Meta, as an example, are currently trading in more value stock territory with a price to earnings ratio of just 12 times earnings, which as of right now is way below the current market average. However, if Meta earnings start to fall in the future as companies start to make less money and therefore start to spend less on marketing and advertising campaigns on Meta or Facebook, with this obviously being one of Meta's core revenue streams, that will obviously go on to have a massive knock-on effect on the company's financials on the whole, and therefore potentially result in them actually earning less money in terms of bottom line profit. And therefore we'll then start to see the earnings compression which Burry spoke about in his tweet. At which point further selling obviously then starts to take place, because if you think about it from kind of an investment sentiment point of view, not only are we seeing the kind of price of a stock rapidly fall down, but then if you started to see the company's earnings also start to fall down, then obviously investors, just based on the broader macroeconomic environment, certainly see it as unfavourable to hold these types of securities. And that is, in a nutshell, what Michael Burry is forecasting. And to be fair to him, he certainly makes logical arguments, and that's probably why he's been right about a lot of predictions he's made in the past. He even went on to tweet and also patted himself on the back by saying, just getting one thing right is hard. The 1999 tech bubble, the 0105 value revival, the 2005 housing bubble, 2009 almond farms, 2020 COVID bottom, lockdown horrors, 2021 meme stocks, 2021 crypto leverage, 2021 inflation, 2022 is not done yet, and late 2022, question mark, question mark, question mark. So there's certainly no question around Burry's ability to understand the broader macroeconomic environment and kind of build out his own thesis and analysis and forecast based on his understanding of it. And that's obviously what makes him also a very good investor, because over the course of his lifetime, as it says on Google, he's managed to acquire a net worth of about $300 million. But I guess the caveat to that is, whilst Burry makes these kind of bold predictions, actually, whilst they're not always wrong, sometimes he is a couple of years too early, just like he was predicting the housing market crash of 2005. But luckily for him, he was able to hold on to his short positions for just about long enough for the housing market to actually go on to crash. And whilst we're on the topic of talking about the kind of 2008 style market crash, which Burry has referenced before, that doesn't necessarily go to say that the same kind of size and scale of market crash is going to happen in 2022. In actual fact, it could potentially be a multi-year event where it doesn't take kind of 6 to 12 months to take place, and in actual fact, it could take 2 to 3 years. And that doesn't mean that we'll see a continuous and rapid drop in market prices like we saw, I guess, during the flash crash of March of 2020. And Burry also recognizes this point when he made this tweet, which says, "Dead cat bounces are epic. 12 of the top 20 Nasdaq one-day rallies happened during the 78% drop from the 2000s, and 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top." So clearly we have these kind of mini rallies in stock market prices as part of what is a broader downward trend. And on a personal note, that's what I believe will continue to happen for a period of time. And to be honest, none of this is dissimilar from the kind of discussions that we've been having on this YouTube channel for the past 12 to 18 months. However, it is always good to hear the same kind of broader macroeconomic market thesis from one of the seasoned investors like Michael Burry. So in light of that, I thought I'd leave you guys with this final tweet, which I thought was quite fitting. "Knowing is half the battle. Got it? It's not hard. Analyze, think independently, be informed, find the data, and you'll know a lot that no one else does." And I think that's a very important point to make, because if you're planning to be a stock market investor or perhaps even a stock picker, then being an independent thinker is an extremely important characteristic to have. Develop your own analysis and your own investment thesis, because that will certainly help inform your own personal investment decisions moving forwards, and hopefully allow you to go on to perform better as an investor too. So with that said, if you're interested in my analysis along with the investments which I'm making, then be sure to click on this video here. But before you go, be sure to subscribe to the channel, and once you've done that, I'll see you over in the next one.